Let's talk about income-producing real estate financing for a moment. Financing residential home loans for personal use is not the same as obtaining a loan for real estate business purposes. That is, buying a home as a personal residence versus income-producing real estate. To clarify, there are both residential and commercial properties that may serve as income generators for an investor. So the term income-producing real estate encompasses both residential and commercial. What are examples of income-producing real estate? One is purchasing fixer-upper single-family homes for the purpose of house flipping. Another is acquiring apartment rental properties to generate passive income over the long term. A third example is owning an urban, multi-level building containing law offices, short-term rental spaces, and retail venues. Financing income-producing real estate has some important differences, including interest rates and shorter loan terms. Traditional mortgage financing includes more standardized, rigid terms plus stricter requirements for borrowers. Income-producing real estate loans tend to have a wider range of interest rates, and they also have more flexibility built in. This is thanks to an abundance of financing options and less stringent requirements for the borrower. So, what financing terms are typical for an investment property loan? We have distilled it down to 4 aspects. The term of the loan tends to be much shorter and typically matches the lease period. The initial fixed interest rate is only for a specific period of time, then enters into a floating period. Interest rates vary but tend to be higher, and the mortgage loan is often based on the cash flow of the property instead of its appraisal value. Compare these aspects to the key characteristics usually seen for a traditional 30-year home loan secured by residential property. These loans are amortized evenly over the term of the loan. They have a fixed interest rate throughout the loan period. They're characteristically in high demand, and they're often based on the appraisal of the home rather than the cash flow of the property. Overall, the financing options and terms for income-producing properties tend to be shorter term and less restrictive than traditional owner-occupied home loan financing. If a client is an investment real estate buyer, tell them it's important to shop around for the best financing to suit their particular situation. It's also vital for them to evaluate their investment strategy to be certain that a particular loan makes good business sense for them.